Hello, everyone. Thank you for attending. My name is Si Wing Yi from the Yi Real Estate Network. We could have a very interesting presentation. This should be the most important presentation in my company's history. All right? It's called the Big Three of Real Estate Investing: the Bakken, Permian Basin, and Eagle Ford oil boom housing markets. Once again, my name is Si Wing Yi from the Yi Real Estate Network, and I'm very proud to present this numerical review of how to achieve financial freedom based on my unique methodology. This is all about the big threes. No, I'm not talking about the big three of LeBron James, Dwayne Wade, and Chris Bosh of the NBA's Miami Heat. I know they're no longer together as LeBron went back to Cleveland Cavaliers early this year, and I like it actually. Yep, but they left a lasting impression in the NBA landscape as the Heat reached the NBA Finals 4 times from 2010 to 2014 and winning the NBA title twice. Believe me, I love LeBron James. Breaking news. It appears that there's a Big Three 2.0. That's right. Kevin Love has been traded from the Minnesota Timberwolves to the Cleveland Cavaliers. The new Big Three will be LeBron James, Kevin Love, and Kyrie Irving. Wow, can't wait until the NBA season begins shortly. You can also leave a lasting impression if you are committed to do what I am about to show you. I'm talking about the Big Three oil shale boom housing markets of the Bakken, North Dakota, Permian Basin, West Texas, Midland, Odessa, and Eagle Ford, South Texas. Based on my extensive research and due diligence, I believe the key to your financial freedom is investing in these three housing markets. Why am I so confident? Well, many of my investors have purchased homes in the three oil fields from 2012 to the present, and they have experienced tremendous growth in their real estate portfolio since. All my research indicates that three oil fields have the following characteristics. The advent of new technology called hydraulic fracking is a game changer, and the world's economy will be a better place as a result. 2. It is estimated that there are at least 20 billions of barrels of oil to be extracted from the three oil fields. Therefore, it is believed that it may take 30 to 50 years or more before all of the oil is fully extracted. 3. This oil boom is causing severe shortages in housing. All the oil field and oil servicing companies would much rather create corporate leases on behalf of their workers than having to put them up in hotels and trailers and man camps and other temporary lodgings. It costs them a lot less money to lease it from us with our permanent stick-built townhomes and twin homes. 4. We are leasing our typical homes priced from $225,000 to around $263,000 at a monthly gross rent of $3,000 to $4,000. Unbelievable, but true. It is believed, listen very closely, there's a reason why I have underlined this. It is believed these elevated rents will continue for at least another 7 to 10 years or more before the supply of homes catches up with the demand. Okay? That's very reassuring. It is just my belief, my projection, my research. Then after that, after the 7 to 10 years approximately, the rents may gradually go down 10, 20, 30, 40, or even 50% to a mere $1,500 to $1,000 monthly gross rent in the second decade of your investment ownership. Still positive cash flow based on this estimate. Isn't that nice? Okay? 5. Let's use a baseball analogy. We are at the top of the first inning of a 9-inning baseball game. As a matter of fact, we are even at spring training. Some baseball games go extra innings, as you know, sometimes for up to 13 innings or more before the game is ultimately decided. Well, the oil boom is no different. We have a long way to go. this oil industry will most likely keep going after we are gone from this earth? I will address some of my investors' concerns. One, the oil fields will go bust as it did in the past. My answer? Highly unlikely. New technology will make sure of that, as indicated earlier. Two, the government may shut oil drilling down due to environmental and concerns and regulations. My answer? Highly unlikely. Most oilfield drilling is done on private land. Furthermore, although this is a concern, there has been no fully documented records that there have been significant environmental impacts so far. The oil industry has been implementing safety measures to ensure there are no major incidents moving forward. I'm very confident of that. If you have any personal or political reasons, such as you are anti-fracking and this is the reason you do not wish to invest in the three oil field markets, sorry, I will not engage in this discussion with you. My goal is to help you make money and achieve your financial goals, not to discuss politics or your deep-rooted personal feelings. You are letting your personal feelings get in the way and potentially sabotage your financial security for you and your family. Now that I got all those issues out of the way, let's talk numbers, right? Because after all, numbers are the key to your financial freedom. Agree? Agree. Yes, yes. Let's discuss the concept of rate of return. A very simple illustration, a tale of three investment strategies. Option one, the stock market, mutual funds, individual stocks, whatever. Option two, invest in non-oil field homes. And option three, investing in any of the three oil field markets, as I mentioned. Scenario, you have $50,000 at risk investment as a down payment, which is typically 20%. Option number one, if you continue to put this money into the stock market, on your initial 50,000, let's say you're earning a 5% return, and I'm being gracious. 5% return multiplied by $50,000 of your investment at the end of the first year, a measly $2,500 increase. Question, how many years does it take to recoup your initial investment back? Answer, 20 years. 50,000 of your money divided by $2,500 annual return. Well, hate to say this is pathetic. Okay? Option two, buy a rental property in a non-oil field market. Example, Florida, Georgia, Indiana, Arizona, Tennessee, Texas, California. Just some examples, okay? You're buying $250,000 property at 20% down equals 50,000. I mean, look, I just want to make this point. I mean, I'm not going to go over too much detail like closing costs or maintenance and upkeep and vacancies. You know, those things will happen, but I'm just giving you a high level numerical illustration, all right? And I'm not even, don't even ask me about taxes. Taxes is just, I mean, just part of the whole process. I mean, this is not the time to talk about that, all right? Anyway, $2,500, let's assume you're getting $2,500 monthly gross rent, all right? So equals a 1% rent to value ratio. Okay, 1%, $250,000 multiplied by 1% is $2,500. That is the sort of the benchmark for positive cash flow property. So 1% is a good benchmark. So minus debt service, your mortgage, your real estate taxes, your property insurance, and your property management fees, let's say around $2,000. So $2,500 gross rent minus $2,000 on this purchase equals net monthly cash flow of $500 multiplied by 12 months you will have received $6,000 of annual net cash flow. Okay, follow me. So $6,000 of annual net cash flow on that property in a non-oil field area divided by $50,000 of initial investments, your cash and cash return is 12%. Not bad. Okay, not so bad. Question: how many years it takes to recoup your initial investment? Very simple. 8.3 years. $50,000 of your down payment investment multiplied by $6,000 of annual net cash flow equals, you're going to recoup your money in 8.3 years. Not bad. But not as good as option 3 by any of the 3 aforementioned oil field housing markets. Same purchase price, $250,000, 20 to 25% down and all that, $50,000 for the sake of simplicity. All right. However, here's the key, right? It's the rent. A typical $3,500 monthly gross rent. That's right. Equals 1.4 rent to value ratio. This is very significant. Minus debt service. Again, your mortgage, taxes, insurance, property management fee is $1,800, for example. So $3,500 gross rent minus $1,800, your net cash flow is around $1,700. Multiplied by 12 months equals $20,400 annual net cash flow. How about that? $20,400 of the first year net cash flow divided by your initial down payment investment of $50,000 equals 40% cash on cash ROI. Your rate of return. Okay? How many years it takes to recoup your initial investment? And the answer, 2.5 years. $50,000 of your down payment divided by $20,400 annual net cash flow. You can't beat that, right? No brainer. So the recap: option 1, stock market return 5% or less. Option 2, invest in non-oil field home at 12%. Option 3, big 3 oil field home, a whopping 40%. I rest my case. The numbers does not lie. Now that I have proved to you that investing in a big 3 oil field is lower risk than you thought, let's continue with the number crunching beyond the 2.5 years it took to recoup your money, shall we? Here we go. Let's assume these high rents will continue for 7 years. Very simple math, okay? $20,400 annual net cash flow multiplied by 7 years, $142,800. Your total net cash flow in your pocket in 7 years. Let's also assume after 7 years, the rent will go down, of course, by 50%. From 7th to the 20th year, okay? So, therefore, the net cash flow from the 7th to the 20th year is $11,200 annually net from the 7th to the 20th year for 13 years. So 13 years multiplied by $11,200 net cash flow equals $145,600. So you add $142,800 on the first 7 year and $145,600 cash flow for the following 13 years, for total 20 years, you will obtain profit $288,400 in total 20 years of holding the property. And now I'm not even talking about appreciation. That's not even in the equation. I'm talking on a pure cash flow. How about them apples? Right? There are other potential exit strategies, and I've spoken to many investors over the past few years about various exit strategies. So here we go. I have several. You can like this. 1, based on 20 or maybe perhaps 25% down payment with 80 to 75% loan, investment loan. What you do, since you have such a high cash flow, you pay your extra principal per month using the money from the cash flow. Accelerate the mortgage and paid off the 30-year mortgage in 6 years. Think about that. Then your rental home will be free and clear. Well, of course, all you pay is taxes, insurance, and property management fee. But without a mortgage, the typical mortgage is probably around $1,000, right? Without that, then your cash flow will be significantly increased for years to come for your great retirement. Exit strategy number 2, sell your home at the so-called peak. I don't know when is the peak. Let's project it is 7 to 10 years when the supply of homes maybe catch up with the demand in the 3 oil field markets. Okay, so you can sell. So when you sell, when the selling price is greater than your original purchase price, the difference is capital gain, is your profit. Yeah, you have to pay taxes at your ordinary, at the capital gains tax. I don't know the rate at that time, but you should make some money, right? Holding for this amount of time. So nothing bad about selling your home, pay your taxes, and go off in a wild blue yonder. Okay. Exit strategy number 3, do 1031 tax deferred exchange into other housing markets. Right? I don't want to get too technical, but I have other, I've done webinars and live events on 1031. Of course, I educate my clients a lot. So do 1031 in the other markets. Therefore, you sell your property, do not pay your taxes on your profit as long as you trade up to another property or properties. For example, to a multi-unit, to a commercial property, some other markets, then you will continue with the cash flow. Those kind of things, right? Is a very good leveraging strategy. And as a 4th exit strategy, this is one I really like. All the great cash flow you've been getting monthly and annually, if you do a calculation, you can use your annual cash flow from your oil field homes to buy one rental property per year from a non-oil field market. Typically $100,000 property in other markets, as I mentioned, Indiana, Florida, other parts of Texas or Tennessee, whatever, right? At 20 to 25% down, all you need is about $20,000 of down payment to buy one of those cookie cutter homes once per year from your cash flow of your properties. Isn't that great? So, if you're going to buy for the next 5 to 10 years, if you have a long-term investment strategy, you can buy 5 to 10 homes just by leveraging your cash flow. That's it. Amazing leverage. Amazing way to make your money work smart for you. In summary, I just use an example of one rental purchase with 50 grand down. Very little risk, right? Imagine if you have more money to buy. What if you have some money in IRAs? A lot of people have a lot of money from the IRAs. You can convert it to self-directed IRA and you can buy more, right? You can achieve retirement sooner than you think. No other investment out there that will give you the type of returns than from these big 3 oil bull markets. You can make money or you can make excuses, but you can't have both. I rest my case. Thank you for listening. My name is Si-Wing Yi from the U Network. Good luck, and I will see you on the other side.